Hello, Business 600A students. This is Professor Hassey. This is our week 5 of our online class. Today's date is Wednesday, March 1st. So happy March to everybody. Tonight, our discussion is statement of cash flow and financial statement analysis. This is the midpoint between accounting and finance, because the statement of cash flow and the financial statement analysis of financial statements leads into the information you need in the study of finance. So next week, in the last 3 weeks of our class, we'll be concentrating on financial management issues, finance. And tonight we wrap up our accounting or financial statement segment of our course with a review of what the statement of cash flow is and what is some key financial statement analysis information. Trend analysis, liquidity, solvency, profitability. We'll learn about those tonight. You have you have assignment number 3 due this Sunday, March 5th, which was posted last week, which is the final closing process of accounting that I'm asking you to do. So remember, that's due Sunday. We have a case study being posted this week on Friday. The case study is a paper you'll be doing in regards to both accounting and finance, a 5 to 10 page paper that you'll be doing. I'll be introducing that and posting it this Friday, along with an introduction video. So look forward to that. That is not due until March 19th. So assignment 3 this week, finishing up our accounting studies. And in the case study, which will be posted later on this week, which will be highlighting and due March 19th. And then our discussion tonight, today, this week, of the changeover from accounting to financial management, financial statement analysis, and the statement of cash flow, chapter 12, certain pages in chapter 12 and chapter 13 of your textbook. Okay, here's where we are in Blackboard at the present time. This is week 5. We're now in the second half of our course. And in week 5, we have chapters 12 and 3. This is a spreadsheet that I'll be going over a little bit about statement of cash flow and financial statement analysis. It's right here. You can follow along or use it as a template as I put it out together, discuss it this evening. And then some key points of the statement of cash flow and financial statement analysis, and some PowerPoints if you so desire to look at about those 2 topics. So that's our subject for this evening as we begin to transfer or translate, or however you want to put it, into the world of finance beginning next week. So let's take a look at the statement of cash flow and financial statement analysis, chapters 12 and 13 of your textbook. Again, I'll be available this Thursday evening for office hours. If any of you have comments or questions about your assignment 3 that you're working on this week. And if you have any other additional questions, please feel free to contact me. We've now completed half of our course. If you have any suggestions, any complaints or anything, please feel free. You can contact me. Or if you just want to let me know how you're doing and chat a little bit, that's fine too, on Thursday evening, tomorrow night. But you can chat with me anytime. I'm available at all hours of the week. Also, remember that as we head to the final second half of our course, make sure you understand where you stand in the class, checking your grade average, checking your grade assessments that I have posted, making sure you understand where you stand in the class. If you have any issues or concerns about your grade, please feel free to let me know. So let's take a look at statement of cash flow. Okay, here's that file that's in week 5. It's called the Spring 2023 week 5 in-class review. And this highlights the key parts of your reading in chapters 12 and 13 that I need you to grab and to understand to move forward in the class, because part of your case paper will be concerning these very topics of this evening, and also future assignments. So, and also the final examination. So this is a key part of our class, and make sure it kind of as I said earlier, we've now moved from accounting to finance, and these are the two areas that helps us in that move from understanding accounting to understanding finance. So we're all familiar with, and we've all done them, the balance sheet, the income statement. Those are the two main financial statements of a company. These financial statements provide a historical review of a company. Are we maximizing our value? And it provides data for future planning and financial management. And that's where we're heading to over the next second half of our course. Planning, strategy, financial management. So the financial statements of a company, as we know from accounting, it's the summary of accounting transactions, closing the books, and recording the assets, the liabilities, the equities, and the sales, revenue, expenses, and profits, hopefully, of your business. And that's what the financial statements are. And you've done these thus far. Now we learn in chapter 12 another financial statement that combines both of these financial statements, the balance sheet and the income statement. Just to refresh your memory, remember the balance sheet is a statement of things that you own in your business, assets, things that you owe, liabilities, and the ownership share of the assets, equity of your company. And it's on a given date. On December 31st, 2022, this company, Reggie Dunlop Incorporated, had $3.5 million of assets. This is a classified balance sheet where it breaks down current assets and long-term assets. At the same time, this company on December 31st, 2022 had $1.5 million of liabilities made up of current liabilities, short-term liabilities have to be paid within the next year, and long-term liabilities, in this case, bonds. Plus the equity of the company, which is made up of two accounts, common stock, the amount of value of invested stock in the business by the market, and retained earnings, the accumulation of profits. Remember the retained earnings statement from our financials? This is where you accumulate the profits or even losses of your company throughout the life of the business. This is where you close the revenue and expense accounts to retained earnings along with the dividend account. So the balance sheet is on a given day, usually the last day of the fiscal year of the company. Then you have income statements. The income statement is a statement for a period of time, usually 1 year, but you can do income statements and financial statements on a quarterly basis, even monthly. But the most important one is for the 12-month fiscal year of the company, where you report the sales of the business, revenues, and the expenses, and the interest that you pay on your debt, and the taxes that you pay the federal government. And after all of that, you have what is called net income, revenue less expenses. Notice this company lost money in 2021 and made a profit in 2022. At the same time, this income statement says that the company paid out in 2022 22 cents a share in dividends. Well, at the end of 2022, they had $250,000, 250,000 shares of stock outstanding owned by the market. If you take 250,000 shares of stock and multiply it times 22 cents a share, that means the company paid out $55,000 in dividends. So when this company closed the books for 2022, they closed out all the revenue, all the expense, and the dividends account, exactly what you're doing in assignment 3. And they closed those accounts to retained earnings. Now, if you notice in the retained earnings account from 2021 to 2022, they had a change of that account balance by $198,584. How did that number get there? Well, the company made a profit of $253,584. They paid out $55,000 in dividends. That gives them a net delta of 198,584 in retained earnings. That's how that account changed when this company closed their books. The revenue and expense accounts at 253,584 went in as a credit to retained earnings, and a debit was hit to retained earnings of the dividend paid out for the year of 55,000. The net effect was a delta or a change of 198,584. And that's an important concept. That's where the income statement, a statement of a year's operations, meets the balance sheet, the statement of balances on a given day. So on December 31st, 2022, the company had accumulated $296,216, which was the result of all the revenue and expense and dividends accumulated over its life into the future. So that's the balance sheet and the income statement. We're pretty familiar with that in our work these first 4 weeks. But now we get to the third main financial statement of a company. It's called the statement or the cash flow statement. It's a statement indicating where the cash came into the business, which is called a source of cash, or went out of the business, which is called a use of cash. Statement of cash flow. This is very important to the financial managers of a business. Are we generating enough cash to pay our bills? Are we generating enough cash to meet the growing needs of our company, to invest in new assets, and so on? Are we using our cash to pay back liabilities, to pay dividends? That's an important statement in the financial management, and investors look at this statement before they look at anything else. Is the company creating value, creating a return of cash that can be distributed in the form of dividends, and also can be related by the market indicators to add value or increase the stock price of the company? The statement of cash flow. And what the statement of cash flow is basically a combination of the balance sheet and the finance and the income statement. It's a combination of those. The net increase of profits, net income, the paying of dividends, the recording of depreciation, all are statement of cash flow accounts. And then all the deltas of the balance sheet are all making up in the statement of cash flow. How the business has changed, and the bottom line of any change is cash. So notice something here that's very interesting. I'm highlighting it here. Notice the cash position of this company changed from 2021 to 2022 by $6,718. If I go over to the next tab, that's exactly how much the statement of cash flow is indicating how cash has changed, $6,718. So the reader of the statement of cash flow can get a pretty good idea of where this $6,718 of change in cash from the prior year came from. And that tells you a lot about the business. Remember, I said there's two forms of cash: sources, money coming in; uses, money going out. And that's what this statement is showing us. Money coming in, net income; money going out, dividends; money coming in, depreciation; money going out, the payment of debt; money coming in, additional accounts payable borrowing; money going out, the purchase of fixed assets. All this statement tells the reader, both externally and internally being the managers of the company, externally meaning investors, bankers, prospective investors, about how the company has changed in regards to cash management over the prior 1 year. This is very important. So, as we said, the balance sheet changed cash value by $6,718. The statement of cash flow shows us where that money comes, and it shows us in three distinctive groups: the cash flow from operations, the cash flow from financing, and the cash flow from investing. All of those are the three areas of money coming in, sources, money going out, uses of cash. Operations is made up of income statement accounts, net income, depreciation, and current asset and current liability accounts, accounts receivable and inventory, accounts payable, and accruals, short-term operating capital. Let me tell you something that's kind of weird about this. First of all, net income, that makes sense. We made a profit on our income statement of $253,584. There it is right there. Okay, I can consider that cash coming in. Fine. At the same time on the income statement, as an expense, they show us $120,000 of depreciation. This is a difficult thing to swallow for a lot of first-time users of this. $120,000 of a depreciation expense. It's reducing profits. There it is right there on the income statement. But you add it as a source of cash on your statement of cash flow. Why? Well, as many of us know, depreciation is a way of expensing fixed assets over time. It's an adjusting entry on our records. But when you record depreciation, do you spend any money? Do you actually write a check to Mr. or Mrs. Depreciation? No, you don't. Depreciation is an allowable expense by the Internal Revenue Service to write down the value of your fixed assets, but you're not spending any cash. Thus, we made $253,584 in after-tax income or profits last year, but a lot of that was $120,000 of depreciation expense. So we're going to add that back in here as additional profit, as you could say it, additional capital, because it was non-cash. So depreciation is a source of cash flow for a business. Look at the current operating assets, receivable and inventory. On the balance sheet, notice accounts receivable has increased by $245,840. Inventories has increased from 2021 to 2022, $429,120. And notice on our cash flow statement, those two amounts are in negative numbers. That's negative cash flow. In other words, money going out of the business. Excuse me. In other words, if our receivables go up, that means that's money we have yet to collect. People owe us more money. So we've recorded the sale on the revenue. That revenue is in the income statement, but now we're giving part of that back because it's receivable. And we won't get that money until those people pay off their receivable to us. Cash flow. So that's negative cash flow, the increase in receivables. The same thing for inventory. We purchased more inventory in 2022. That's inventory that we either bought or produced that's sitting in inventory that we have yet to sell. We've paid for it, but we haven't sold it yet. Negative cash flow, $429,120. See that there? And then we get into the current operating liabilities. This is the direct opposite. If you notice on the balance sheet, accounts payable has increased by $35,800, and accruals have increased by $95,040. In other words, we owe more money. Well, if we owe more money, that means we haven't paid it out. We haven't paid those expenses, those liabilities. That's money, cash flow that we've saved. Now, eventually, and within the next 30 days, probably in this business in January, they're going to pay those bills. Well, that's when the cash flow will be going out. But in this case now, it's additional cash coming into the business because we haven't paid it yet. So if you notice, $35,080, $800, and $95,040 are both positive cash flow from operations. An increase in receivable and inventory negative cash flow, an increase in payables and accruals, positive cash flow. Kind of drives you batty trying to think about that. Notice in the balance sheet under current liabilities, we do not include notes payable. Notes payable is the current portion of an interest-bearing debt. If it's interest-bearing, then that will be in the financing section of our cash flow statement. So we just put in non-interest-bearing liabilities in operations. So if we take that into account, net income, depreciation, accounts receivable, inventory, accounts payable, and accruals, we have a negative operating cash flow of $170,536. That's not good. Most companies want to have at least a positive cash flow from operations because that money helps them fund other sides of the business. Well, now we get into the financing side of the cash flow statement. It has to do with long-term debt, common stock, and dividends. So let's take a look at the long-term debt on the balance sheet. Notice our notes payable was reduced by $420,000 and our long-term bonds were reduced by $500,000. That means we paid off that debt partially. So on the cash flow statement under financing, it's negative cash flow. We paid $420,000 down on our notes payable, and we paid $500,000 down on our long-term bond obligations. So cash going out because we reduced the balance of those liabilities. I'm going to skip over common stock for a minute and go to dividends. Remember, we paid out 22 cents a share of 250,000 shares of stock in 2022, $55,000 of dividends. We're writing a check to our shareholders and giving them 22 cents a share, their share of the profits of the business. So on the cash flow statement under financing, there's that negative $55,000 of cash going out, a use of cash called financing in the form of dividends. And lastly, the big kahuna of this year with this company, notice common stock. First of all, notice at the end of 2021, we had 100,000 shares of stock. At the end of 2022, we have 250,000 shares of stock. Oops, they've increased their stock by 150,000 shares. That means they must have issued 150,000 shares more of stock to the market. And how much cash did they receive? Here it is down here. Common stock was $460,000 balance at the end of 2021. At the end of 2022, $1,680,000 because we issued 150,000 more shares of stock in the market. The net delta of that from 21 to 22 is $1,220,936. They issued additional stock to the market and got cash for it, and that cash increased the cash position of the company. So if you look at the cash flow statement, there's a positive cash flow for common stock of the company, taking into account payment of liabilities long-term, payment of dividends, and money coming in by the issuance of those 150,000 shares of stock. They had a positive $245,936 of positive cash flow in finance. Now, just want to highlight one thing, and we'll talk more about that when we get into the finance side of our class in another couple weeks. Issuing common stock is the most expensive form of raising capital. It costs money to hire accountants and lawyers to issue that stock for you and represent your company in the marketplace. And the investors who are giving you the money in the form of stock certificates are going to want a hefty return every year. If you don't give them that return, they're either going to sell the stock or dump you. Remember, shareholders are owners. They can control your fate as running the business. Very expensive. So why did this company have to do that? Because they have negative cash flow operations and they had debt that they wanted to pay off to clean up their balance sheet. They needed the issuance of new stock to do that. The bad thing about it, though, most companies use common stock sales to finance the purchase of additional fixed assets, equipment, buildings, investment, because they want that money to be put to work to continue to grow the company. Here in this company, a fatal mistake, they're using the issuance of capital common stock to pay back old money, old debt. Not smart. And we'll talk more about that when we get to looking at financial management. The last form of cash flow is the investing side of the business, where you put your money to work in outside the company in the form of investments. And there's two in this company. Short-term investments, which is considered a current asset, kind of like a money market fund or putting money aside. If you notice in the delta of this business over the course of 2021 to 2022, they increased it by $51,632. At the same time, if you notice their gross fixed assets, the amount of investment in their new purchase of new equipment, new whatever that might be, buildings, land, equipment, computers, had an increase of $17,050. So they invested $17,000 more in long-term fixed assets. Both those deltas are part of this investing section of the cash flow statement. There it is, cash going out, $51,632, cash going out, $17,050. Remember, when assets increase, that's negative cash flow. And there it is right there. So in investing section, they had a negative $68,682 of negative cash flow in investing. So if we do our arithmetic, operations plus in financing plus investing gives us a net of $6,718, which is exactly how much our cash position changed in 2022. This statement of cash flow gives, it's like, I use this example and it's kind of corny, but it works. The cash flow statement is like looking under the hood of a company. The balance sheet and the income statement are the nice, pretty financial statement that gives the overall big macro view of net worth or net wealth and profits. But if you want to see where all this money is going, coming in and going out, you got to go to the cash flow statement to see where this money is going in and coming out of the business. It's like looking under the hood of a car. There you really get to see the engine, and is the car, you listen to the sound of the engine, is the car operating efficiently? So the cash flow statement, for a corny example by Professor Hasse, is looking under the hood of a company. Very important statement to understand. And it's broken into three areas that you need to concentrate on as far as your learning is concerned: operations, financing, and investing. And we'll be looking at some of this in your case paper for the companies that you've selected in this class. Now, the next form of analysis is Chapter 13, Financial Statement Analysis. And here we're looking at a variety of things that tell us about the trends within the company. How has the company changed over time in relationship to their own operations, but also relative to the industry or their competitors in their business? And Chapter 13 talks about this. And there's 6 main areas that I want you only to concentrate in regards to financial statement analysis. It's current ratio, which is a liquidity ratio, a debt ratio, which is a debt management ratio, a profitability ratio on sales and on assets, market value, and earnings per share. These are the 6 that you need to know about for your case paper and for your final examination. Concentrate on these. Know how to calculate them. Know what they represent. Know what they mean. That's what you should look at in your reading in Chapter 13. And here they are right here. And I'm going to apply them to our company here. The current ratio is a formula of current assets divided by current liabilities. So if you take the current assets of our company, which is right here for 2022, and divide it by the current liabilities, it's telling us the relationship of what we have as ownership of current assets to what we owe of current liabilities. So if I take that over here and I move this over to 2022, our current ratio is very high, 2.58. And that's because of our high receivable and inventory balances. That's why. It's a little bit high. Notice the company or the industry average is 1.25. That should tell the management of the company that they better start collecting their receivables and their inventory and sell off their inventory. We just witnessed the Super Bowl a few weeks back. Yes, it was a pretty decent game. Yes, the halftime show was kind of hokey. But the main thing of the Super Bowl is for companies to sell off inventory, advertise to sell applications, to sell movies, to sell beer, to sell cars, whatever. Inventory sell-off is the goal of the Super Bowl as far as advertisers are concerned. You got a lot of eyes watching the game, so you got a lot of eyes willing to watch your products that they might purchase. This company has an inventory problem because they have high inventory. They need to clean that up. And that's called liquidity. It's a liquidity issue. Current ratio. The next important ratio, and perhaps the most important of all, is called the debt ratio. Total debt of the company, which the total debt in the balance sheet is right here of 1,539,000, divided by the total assets of the company, 3.5 million. What percent is total debt to total assets of the company? The industry average is 60%. Pretty good. That's pretty average. Last year, this company had a huge 81% debt ratio. Not good. 2022, it's a little better, only 44%. And we kind of know the reason why. Remember, we paid off $920,000 of debt last year. We cleaned some of that up. And that was made to help our debt position. Another name for this number is leverage. A company with a high debt position, and a high debt position is usually anything over 75%, has a lot of leverage. In other words, they don't have much additional cash flow because they got to pay off that debt. That's why this company used common stock capital to pay off existing debt. They wanted to reduce their interest expenses. They wanted to reduce their payments on the loans. So they cleaned up the balance sheet a little bit. But the expensive thing about that was that they used the most expensive form of financing, issuance of stock, to do that. Not good. The debt ratio, the statement of what percent of the company is in debt. The next three are profitability relationships. The relationship of net income to sales. We lost money in 2021, but in 2022, they made a profit, and that relationship was 3.6% profit margin. The industry average for this industry that this company does business with their competitors, 5.25%. So they're a little bit behind there. They're not making as much profit as their competition. Could tell you something about the company. The next relationship is a profitability statement as well. Net income divided by total assets. Return on total assets. So in 2022, 7.21% net income divided by total assets. That's still a little bit behind the industry average of 9%. So you can see some ugly trends here of this business. They're not in sync with their competition. And the last profitability relationship is called earnings per share. And as MBA students, many of you probably have heard about this one. The relationship of the net income of the company to the outstanding shares of common balance, outstanding shares of stock. Remember, earnings per share is used a lot in the media. Companies don't want to say, well, we made $253,584 last year. We actually made $1 per stock, our earnings per share. It's an easier way of translating profits. The market likes it when companies use the earnings per share because it keeps it simple, keeps it easy to understand. Net income divided by outstanding shares of stock, the earnings per share, a very important indicator about companies' performance over a period of time. Notice they're a little bit behind again to the market, to their competition. And then finally, what is called the price earnings ratio. This is the current stock price in the market, what people are paying for our stock, divided by that earnings per share. So in 2022, remember our stock price, if we go to the income statement, our stock price at the end of the year was $12.17. So if we go in and we put $12.17 and divide it by our earnings per share, we get what is called the PE ratio. And this is what this means. And we're going to talk a lot more about this when we get to finance in stock market. In other words, the earnings of this company and the stock price is 12 times greater than the earnings per share. Notice the market for this in this industry, most of the companies have a 10 times greater. That's pretty good. You don't want a high PE ratio, 50, 60, 70 to 1. Why? Because it means your stock is overvalued. The amount of earnings or profits that company is generating is not matching what the market value says it indicates about that stock, the stock price. That means probably that the stock price has room to fall. It's overvalued. It's going to drop. So it's an indicator of companies. If you see a high PE ratio, many companies or many stockbrokers tell you maybe it's time to sell that stock. Or if you have a low PE ratio, anywhere between 5 and 20, it means that the stock is undervalued and maybe it's a good time to purchase the stock. Now, I wouldn't do it with this company, but it is an indicator, and we'll talk more about how this all works when we get to our finance and financial management section of our course in a couple weeks. But basically what we have just done is we've taken financial statement data and applied it to what is called trend analysis, where we take a look at key relationships of that data, current ratio, debt ratio, profit margin, return on assets, price earnings ratio, and earnings per share, and apply it to our industry, to our competition, and how we are doing. Many times when companies, and everybody does this analysis, as you'll see when we start doing our case paper and subsequent work in the class, is that this data is provided to the markets to show how the company is doing. Are they trending up? Are they trending down? Are they staying about the same? It gives us an overview of the macro performance of their financial statements. That's what chapter 13 is about, but you only have to concentrate on these 6 for this class. Those are the most important. So that's week 5, is understanding you're closing the books with assignment 3 this week. You're finishing up accounting. And then you have the financial statements that are now being given to the market and given to the financial managers of your company to do analysis and review as far as cash flow and financial statement analysis, what it tells you about the business. And we'll be practicing this in our case paper and in subsequent problems in our final examination. But that's the core of our transition week between accounting and finance, financial statement analysis, and the statement of cash flow. It summarizes a review of are we being efficient? Are we doing our job? It's a key for companies to generate a lot of cash flow. That adds value. When investors see that a company is generating nice, huge amounts of cash flow, it means they got money to invest. They got money to grow. They got money to pay off debt. They got money to pay dividends. But a company that does not have much cash flow may be susceptible to investor scorn. These guys don't look like they're being managed very well. And again, that's proven when you take a look at the financial statement side of this. This company is a little bit negative compared to their industry and their competitors. They're not doing as well. So that tells you something about this company. Maybe, hopefully now in subsequent years, they're cleaning up their act and doing a little better. But if this continues on year in and year out, this company could be in trouble for a variety of reasons. And most importantly, the investors are going to bolt. Banks won't lend them money. Investors will sell off their stock. They'll have a tough time issuing new stock. So it tells the managers of the organization, we better clean up our act. All right, we cleaned up our act as far as debt this past year. Now we got to clean up our act as far as current ratio, making more money, making sure that we are providing efficiency to our investors, that we're running our business at the maximum value that we can make. And as of now, Reggie Dunlop Incorporated is not in this example. So this is kind of the exercise, we'll talk later in the week about this, is that you're going to be doing in your case paper. You're going to be looking at trends and key points of a specific company that you have selected and tell me about it. Tell me your interpretation. Show me the calculations. What does it tell you about this business in your interpretation? Taking a look at the accounting data and financial statements and explaining how this company is managing financially. Are they efficient? Are they maximizing shareholder value? That's our next step in this class. So please review this week in addition to completing assignment 3. So students, that's where we are as we approach and begin the second half of our class. We've completed our accounting work with assignment 3. And now we move into financial management and the beginning of taking a look at a company, not in the past that the financials and the accounting information tells us, but how do we use this information to take the company into the future? Financial management, strategic decision making. And that's going to be the second half of our class beginning next week. All right. I'll be available tomorrow night, Thursday. If you have any questions or concerns, look for my video on Friday explaining the case paper. You don't have to start the case paper now, but now you have the basic ingredients to start putting that together, and I'll explain that to you in our video on Friday. Have a great week, everybody. See you down the road. Adios.